Good afternoon, TradeStation Nation, and welcome to another special event here in our webinar series. Our presenter today is Mr. Joe Burgoyne, the Director of Institutional and Retail Marketing at the Options Industry Council. Now, the Options Industry Council is the education arm of the Options Clearing Corporation that all brokerage houses and exchanges are members of, and they provide us with support. Is about fundamentals to application, how to trade listed options. Joe Burgoyne is the director, as I mentioned, and as the director of institutional and retail marketing, he's responsible for supporting the institutional and retail educational programs of the OIC, Vandermolen Options and TAG Securities. His responsibility included managing risk, making markets, and the development of proprietary databases. So today we welcome Joe to our presentation. Now remember that everything we're going to talk about here is for educational purposes only. We're going to get some deep meaning and understanding on the options product. All symbols and all the trading ideas that we discuss here are for demonstration purposes. They are not recommendations. Our presentation is not an offer or a solicitation of any kind in any jurisdiction. We're a TradeStation affiliate. It's not authorized to do business. Active trading is not suitable for everyone. Please remember that options trading does carry a high degree of risk and may not be suitable for all traders. I have posted into the chat panel, I think you can see them, they're visible now, two different disclosure information PDF handouts. You can download those. They'll open up in a separate browser window. You'll be able to save those items just to keep yourself abreast of the characteristics and risks of standardized options and other trading vehicles. So without any more of my chattering, I'm going to turn things over to Joe Burgoyne of the OIC, and I want to welcome him today with this presentation. It is, if you are an options trader, you're going to walk away with a lot more knowledge than you came in with. Certainly, if you have questions throughout the presentation, type them in the chat panel. I'll try to address any TradeStation questions that you have, and we'll pass along the presentation questions to Joe. So, Joe, take it away.
Three, two, one, 1, 2, 3. Any better? No luck. Hello? Okay, away we go. Of live presentations, huh, Don? I mean, you just never know. Are tested for fine, but anyway, everybody for hanging.
Joe, let me ask you if you could log off and then log back in. That may help, and I'll try to move this along to a point where we can begin talking about I can do some of the history of the OCC. Does that sound okay? So, my history in the industry goes back a pretty long way as well, and the exchanges that you see, the different logos you see, are the options industry exchanges, and they all make up the Options Clearing Corporation. All trades are cleared commonly, and all of the fees and the profits from OCC support the OIC. All member firms and are charged for all their executions, and that provides the base for the operation there. As you can see here, Joe, you're trying to say something. I know we can't hear you. All right, so as you can see, the OCC annual contract volume by product type, all the various options products that trade in within the American marketplace has hit its peak in, looks like 2011, and we've seen incredible volume throughout this century. So we know that there's a great interest in the option contract, and so annual option volume by product type has grown by billions of cleared contracts yearly. Joe was going to talk about the option product from a fundamental standpoint, talk about the Greeks, the volatility measures that are baked into options trades, option contracts, and talk about strategies, covered calls, protective puts, and collars. All right, let's test Joe's. Now, options are tools. They can help protect your portfolio. They can help enhance your profits. They give you more ways to implement your market research. They make it possible to target a variety of investment objectives. All right, Joe, let's do a sound test. 1, 2, 3.
1, 2, 3.
There you go.
Any luck?
Oh yeah. Okay. So I didn't probably hit all the details on those previous slides, but
all right, I'll take it over. You know, thanks for that, Don, and apologies to I had to put up with that. I'm sorry. You know, just never know with live presentations. But here we go. Options are tools, and I mean, as Don said early, you know, I had the opportunity to, basically be on the floor of the PhilX for 23 years, making markets in the option space, and I've been lucky enough now to be with OIC for over 8 years, and the message, no matter whether I'm talking to retail investors, institutional types, it's almost always the same message. Options are about managing risk and generating income. Aside from that, yes, some people speculate with them, but really it's reduction of risk and income generation. We're going to cover both of those things today, but really what we wanted to start with was a quick overview, and I'm a huge believer, as far as options go, keep it simple. I think there's a lot of misperception out there that options are so darn complicated. You can make them complicated if you wish, but the bottom line is if you spend a little time, basically getting comfortable with the core concepts, really many of which we'll cover in the next 10 slides, you've got a foundation that you can then build upon to apply the knowledge to generate additional income around your portfolio or to manage risk, whichever the case may be. So when we talk about options, we basically talk about rights and obligations. Options are contracts. Buyers pay for rights, sellers take on obligations. Call buyers have the right to buy the underlying stock. Put buyers have the right to sell the underlying stock. Short option call sellers take on obligations. That obligation is to sell the stock, and a put seller has the obligation to buy the stock. 4 simple concepts that if you're getting started might be confusing at first, but if you're in the option space for long, you know these concepts cold. Each contract corresponds to 100 shares of the underlying at the all-important strike price. We'll go through examples of that. And of course, you've got this right or obligation from the time you get into the contract up until expiration. Many of you know, I'm sure, two types of options: calls and puts. Call buyers, basically, as I mentioned, give you the right to buy 100 shares of the underlying, the lingo being you're long that particular contract. Equity call sellers take on the obligation to sell 100 shares of the underlying at that short strike. And again, we'll go through examples to be sure you understand the difference between the price of the stock versus the strike price. Lingo, on the short call side is being short the contract, also known as the writer of the contract. So that's the call side. On the put side, the put equity buyer has the right to sell the underlying stock. Again, you buy a contract, you're long that contract. The put seller takes on the obligation, and again, that obligation is to buy the underlying stock. You sell any contract, you're going to be short, also known as the writer of a contract. Different terms. Every option contract has its own terms. We've got the underlying stock, we've got the unit of trade. Each contract corresponds to 100 shares of the underlying. You've heard me mention this strike or exercise price. That's contract specific. And then you've got the exercise time, most frequently a month, but a number of contracts also have weekly options as well. Option premium, that's basically the price that the option trades for. Option buyers pay a premium, option sellers collect that premium. And in terms of the size of the premium, we got an option that's quoted at $3. Each contract, as I mentioned, corresponds to 100 shares of the underlying. So you take that $3, multiply it by 100, that contract would be worth $300 less commissions. Simple example, XYZ, Jan 40 calls at $3.20. So XYZ represents 100 shares of the underlying if exercised. January, of course, is the expiration month. Following that, we've got the strike price, the 40 strike. That's the exercise price, where the long contract buyer can actually get long the stock if he decides to exercise that contract rather than closing the position prior to expiration. The particular example speaks to a call, so it's a call. That's the option type as opposed to a put. And again, our price is $3.20. You take that $3.20, multiply it by 100, so the value of this contract is $320. Now, the next couple slides speak to in the money, at the money, excuse me, and out of the money concepts for the different strikes. So in our example, the underlying stock price, you can see highlighted in yellow, is $50. So we've got these strike prices both above and below the strike. The in-the-money calls, ITM, the stock price for the call is going to be above the strike price. So those, with the stock price at 50, those 40 calls and 45 calls are in-the-money calls. The at-the-money call would be right at the strike, or right at the price of the stock, so that $50 strike is going to be the at-the-money. And then the out-of-the-money calls in our example would be the 55 and 60 calls. So with each underlying, you've got in-the-money, at-the-money, and out-of-the-money options. And, you got to keep straight whether it's the call or the put. Some options will be in the money, few just at the money, and then oftentimes quite a few are out of the money options. Now flipping it over, the puts that are in the money, at the money, and out of the money. The at the money is going to be the same. Obviously the stock price 50, that $50 put will be at the money, but you can see because the put represents the right to sell the stock, those strikes above that $50 stock price are going to be the options that are in the money, unlike with the calls where the strikes below the price of the stock were the option strikes that were in the money. So with the puts, we've got the 60 and 55 puts that are in the money. That 50 put strike is at the money. the 45 and 40 puts are out of the money. We got a couple examples to just maybe hammer that point home. Importantly, okay, when we talk about option premium, and again, there are only a handful of core concepts: intrinsic value and time value. Okay, that's what makes up option premium. Intrinsic value is the in-the-money amount. As you saw through those last couple slides, a lot of options have no in-the-money amount. They're either at the money or out of the money options. Okay, and in that case, with no intrinsic value, the value of the option is made up completely of time value. Okay, and of course, once we take that option all the way to expiration, the only value that really comes from that option is any intrinsic value or in-the-money amount that that option may have. So in-the-money calls and puts, in the money, by their names, that tells you they've got intrinsic value. Now, they may or may not have time value, a couple variables there. Expiration could be later today or tomorrow. Maybe there's not enough time for any appreciable time value, or those options could be far enough in the money where there just isn't any value to the put-call parity relationship that I'll speak to in a little bit. So in the money calls and puts have intrinsic value and may have time value. At the money calls and puts, no intrinsic value, as I mentioned before, that's all time premium. Same thing with the out of the money calls and puts. No intrinsic value, just time premium. So, quick example. We've got XYZ, it's $53 a share. Now, the Jan 50 call is priced at $5.20. We've got a $53 stock. We're talking about the 50 call. So hopefully you get the fact that that call is $3 in the money. Total price for that option is $5.20. So you can see we've got time premium of $2.20 on top of $3 of intrinsic value. That's how it works. So take, right side of the slide here, you can see for this 60 call, with the stock at 53, okay? So stock's 53. How about that 60 call? Any intrinsic value? Absolutely not. What does the 60 call represent? The right to buy stock at 60. Well, if I can buy stock at 53, we're talking about a strike at 60. That strikes out of the money by $7. But it's still got $2.10 of time value. So clearly, no intrinsic value, and the time value is going to be the entire value of that option at $2.10. So that's a little bit of how the intrinsic value versus time value aspect of things works. So when we talk core concepts and fundamentals of options, we got to get into the Greeks. I actually like to call them pricing components, really, rather than Greeks. It's just I think the Greeks can intimidate people, but really, we're talking 4 or 5, again, pretty straightforward, simple concepts here. So, who makes option prices in the marketplace? We've got 14 exchanges, lots of market makers. Who makes option prices? Well, anybody and anybody who's in the marketplace. Now, their bid and offer spreads may not be competitive, but you as an investor working through your TradeStation platform, if the option bid offer spread is one bid offered at 110 and you're a buyer at 105, you post that bid at 105, you can be the marketplace. You can actually be the NBBO, which basically stands for the National Best Bidder Offer. So everybody who's participating in the option space makes market prices. Some may not be competitive, but anybody, can be in the option space. What's an option ultimately worth? Well, we'll speak in a minute about theoretical values. Without question, an option is worth, what you see on the screen as the bid-offer spread, okay? Price dictates option value. And again, I'll have a couple slides that speak to theoretical values that are different from the bid-offer spread, But an option is worth what people are willing to buy and sell it for. That's the ultimate worth of an option. Option models are helpful, but they do not create option prices. And there are different factors that go into option prices. We don't, the vast majority of investors don't need to get into the inputs of an option pricing model, but just so you know, it's pretty straightforward. The inputs are stock price, strike price, volatility, timed expiration, and then the cost of money, which is basically interest rates less the dividends. That gets plugged into a model, and TradeStation obviously does this for you. And out come the call and put premiums, the theoretical values, and these values, a lot of people call them the Greeks. So in go the inputs, output, call and put premiums are generated, and we get our pricing theoretical values. So the Greeks, what are the Greeks? There are 5 of them. Straightforward concepts: delta, vega, theta, gamma, and rho. Delta looks at the option price in relation to a changing stock price. Vega is option price in relation to implied volatility, the all-important pricing component, implied volatility. Theta is that option price that relates time to option prices. Gamma tells you how much a delta may change as the underlying stock price moves. And then rho is the interest rate pricing component. Let's talk about delta a little bit, okay? Delta is the expected change in the option price when your favorite stock goes up or down, by $1. Stock index, ETF, whatever you're invested in. Deep in the money calls, high deltas. Basically, deltas go from 0 to 100, okay? Or 1, depending if you're using decimals. So in the money options, basically can have a 1 or 100 delta. At the money options, about a 50 delta. And then those out of the money calls and puts have deltas somewhere below 50, as low as 0, depending on how far out of the money they are. So let's go through a couple examples to hammer this point home. 60-day option, implied volatility 28%, rates at 3%, no dividend. Most importantly, stock price is $50. We're talking about the $40 call. Okay, the right to buy stock at 40 with the stock at 50. Hopefully you get the fact that that option is worth at least $10. $10 of intrinsic value, plus in this example, 25 cents worth of time premium. So what if the stock goes from 50 to 51 in one day? So time's not a factor. What's the value of that call go from? Stock goes from 50 to 51. What do you think the value of that $40 call is with the stock 51? I hope you guess something close to 11 and a quarter. How about if the stock goes from 51 to 52? About 12 and a quarter. If that's what you guessed or something close, you're right. Point here is that option moved just like the underlying stock. So it had a 1 delta or 100 delta, okay? Moving point for point with the stock. How about an at-the-money call? Again, we've got the stock at 50, but this time it's the 50 call, right to buy stock at 50. We've got it priced at $3. It's a little harder. Stock price is 50, goes from 50 to 51 in one day. So again, time's no factor. What do you think the price of that 50 call is? Remember, we talked about, the delta, the expected move in that option as the stock moves by $1. We talked about the delta of the at the money being about 50. So if you add 50 cents to that $3, what do you get? Boom, $3.50. Hope that makes sense. A little higher, the stock, goes from 51 to 52. What do you think the value of that 50 call with the stock at 52 is going to be? Well, if it went up 50 cents with the stock going from 51 to 52, it's probably going to go up a little bit more than 50 more cents with the stock at 51 to 52. And that's exactly the case. In our example, suggesting that the call went up 60 cents, so therefore it's a 60 delta. And you can see as that call got in the money a little bit, went from 50 to 51, $1 in the money. From 51 to 52, $2 in the money. That delta continues to grow a little bit from 50 to 60, plus or minus a little bit. But it gives you an idea. Okay, so that's the at the money call. And how about the out of the money? Even more abstract. Again, the stock price is 50. You know, for whatever reason, the investor decided, you know, they're going to buy the 60 call. Okay, the stock goes up. You should make money, assuming all the other variables stay constant. That 60 call with the stock at 50 with 60 days to go, it's valued at 10 cents. Excuse me. Now, if that stock goes from 50 to 51, how much do you think that 10-cent call is going to appreciate by? Now, what do you think the delta of that? That's basically what you're asking yourself. What do you think the delta is of that call with 60 days to go, $10 out of the money? It's hard. I mean, it's to guess, but if the value of that call goes to 17 cents, the delta was 7. And then, you know, taking it a step further, stock goes from 51 to 52. Where do you think that delta may be? Well, it's going to be greater than 7. We know that. So if the call goes to 29 cents, we've got an 11% increase. So maybe that call went, that delta went from 7 to 11, and that's how it works. All right. So just to give you an idea of, you know, using the TradeStation platform, you can get a sense for, you know, lots of examples of how the Greeks work with you, for you in your different positions. As I mentioned earlier, gamma is the expected amount of change in the delta when the stock or index goes up or down by a point. So in that last example, you know, the gamma would have been, let me see, we went from a value of 17 cents to 29, so the gamma would have been 4. We increased by an additional 4 cents. Excuse me, 2. Instead of going from 17 to 27 cents, we went to 29 cents, so we had a 2 gamma there. And that's how it works. Theta, as I mentioned, is the option value sensitivity to time. And those of you who've been in the option space, you totally get theta. You learn about it immediately. If you're long options and your underlying doesn't move, you learn real fast what theta means. It means you're losing money. That time value component in the option decreases and money comes out of your account. You know, you learn that really, really quickly. On the flip side, if you've sold options and the stock doesn't move, you get to see how that, you know, theta can work in your benefit. And basically that's the name of the game, all right? But just, you know, it's a simple concept. On your TradeStation platform, you'll see, you know, the theta quantified in our example. You know, we've got an option at $3.50. If the theta is 3 cents, nothing happens over the course of a day. Boom, the next day your option's worth $3.47. Assuming all the other pricing factors, you know, remain the same. That's important, especially that implied volatility component. But that's how theta works. And, you know, those of you in the option space, you know, theta basically is not linear. The further out you are in time, the less impact theta has on your option. The closer you get to expiration, really inside those last 45 days, is when, you know, some of that theta really starts to decay in an accelerated rate. Vega, I mentioned earlier, is awful important because what Vega does, it drives the level of volatility in your underlying, drives the value of that time component option in your option premium in your option price. We talked about option prices may have intrinsic value, almost all have time value, and it's Vega, which is the component that drives much of that time premium value, which to me is why Vega is the most important pricing component or Greek. And again, your TradeStation platform, you can quantify the Vega value through the pricing models. And one important, you know, point that you should understand, The further out you go in time, we talked, a minute ago about how theta accelerates as we get closer to expiration. Well, clearly, when and we've got options, regular options go out 18 to 24 months. You got leap options that go, beyond 2.5 years out in time. So theta or time decay is not the key pricing factor as an option price goes out in time. The key pricing factor there is vega. So take a look at your TradeStation platform and, for your favorite underlyings, look at the value of vega as we increase time, and you'll see how that pricing component increases, and therefore, it really magnifies how important vega is in, the premium component aspect of the option price. And as the slide says, most important pricing factor, I agree with that wholeheartedly. This, and I know the TradeStation platform has this as well, our website, which is optionseducation.org. If you go under tools and resources, this is one of our implied volatility charts. So the blue line represents historic volatility, which is how much your underlying has moved in the past. That's a statistical measure. The brown line is the implied volatility chart. So you can see how implied volatilities typically will track and are usually a little higher than the historic vol, not always, but it gives you a relative sense and an important core level at what type of volatility the options on some of your favorite underlyings have. And if you're in the option space, that's really something that you should have a sense of. Are my favorite half dozen underlyings high or low volatility stocks? And if so, how does that volatility level equate to option time premium? Something, over time, it would be worthwhile to get to know. And again, I know the TradeStation platform has all kinds of things to help you understand that. The last Greek is the interest rate component. When it comes to pricing, we refer to that as rho. With interest rates, and you'll find that same number on the platform. With interest rates as low as they are now, the interest rate component has really very little impact on your option price. But if you have time, go into the TradeStation pricing calculator, go into the pricing calculator at our website and change interest rates. But if you change an interest rate on a short-term option, it's going to have virtually no impact. It's those longer dated options where change the rate from 2 to 5 to 6%, and maybe you'll see some impact on the option price. But at this point, with rates as low as they are, not that big a factor. So that's really where I wanted to go in terms of talking about the review and then the Greeks, because it lays a foundation for understanding, how our option prices work as we start to apply option prices to our various strategies. This is how, you can find the Greeks on our website. And I mentioned earlier, sometimes, theoretical values, which come from the pricing models, are a foundation for a theoretical price. In our example here, you can see the theoretical price is 7.04, but look to the left where the bid offer spread is, in the call for the 180 strike. You can see we got a theoretical value of $7.04, but the bid offer spread is 805 offered at 815. I was on the floor for a long, long time. This used to happen all the time, all right? Less so, the last number of years as the efficiencies of the market with electronic trading have really improved the markets, done away with a lot of trader types like me for sure, but certainly the efficiencies of the market, and I think Don would support this, have improved markedly for all market participants. I mean, when the market gets crazy, bid offer spreads, always widen. That's just how the markets have always worked. But with the advent of electronic access to the markets, bid offer spreads are far more competitive. Theoretical values more oftentimes line up with bid offer spreads, but the point here is the theoretical value of 704 with the bid offer spread 805 offered at 815. Which one's right? Well, the value of the option is the bid offer spread. So something in the theoretical model went wrong. I won't get into all the details here, but the bottom line is if your theoretical model doesn't match up to the bid offer spread, 9 out of 10 times, what's changed in the marketplace is that dynamic pricing component, implied volatility. And that's the case in this example, and will be the case, with many situations like that. So if you're not familiar with implied, maybe we can talk about it another time in more detail, but, get to know those implieds. I mentioned put-call parity concept earlier. Real quickly, just so you realize, there is a triangle, relationship between your underlying stock, the value of the put, and the value of the call. All right, so it's not like you've got a stock price and then individually call prices and individually put prices. That relationship is a constant in the marketplace. The value of the call, the value of the put, and the value of the underlying are in constant symmetry. Rarely, in the old days before electronic trading, that symmetry would get out of line. That's not the case very often anymore at all. So that relationship is called put-call parity. And again, maybe something, if you have some time and you have the interest, check it out. So let's get in, Don wanted us to talk about basically some theory and then take it to application. Let's do that starting with covered calls. Many of you may know the covered call is when we own the underlying stock, index, or ETF and then turn around and sell a call on top of that. And, that's basically what the covered call is. Why do we do covered calls? Two reasons, but the primary reason is increased returns. The other reason could be for some downside protection. So those are really the two primary reasons for generating covered calls. When we do the covered call, as I said, it's important to realize we need 100 shares of the underlying because each option corresponds to 100 shares of the underlying. For each 100 shares we own, we can sell up to one option. All right, just to make sure we're 1 for 1 in that ratio. If you get into a situation where you're on 100 shares and short 2 calls, that's a whole different margin requirement, and you have to talk to your friends at TradeStation about those different risks. In our examples, we're going to talk about the 1-to-1 ratio. So we've got 100 shares of the underlying, we sell a call, we take on an obligation to sell the stock at the strike price. All right, and for taking on that obligation, we take in the premium that we get to sell that call for. So again, we're doing that basically to generate income and potentially create downside risk. You can see, the different risk charts here, long stock, solid black line, making money to the upside, losing money to the downside. You can see that covered call, risk graph considerably different. It goes horizontal at some point, and that point is the strike price plus the premium we take in. But notice also that there is, where the line meets the horizontal and vertical line is to the left of that midpoint, and that's because, the covered call does offer downside protection. The amount of protection is the amount of premium that we take in with that call. So again, let's run through an example. We got XYZ. We got 100 shares, so we know we're going to be able to sell one call. Stock's trading at 52. We decide to sell a 3-month or 90-day $55 call at $175. So 90 days out, it's the 55 call. Stock's trading at 52. Is that call in, at, or out of the money? I hope you answered out. That call's out of the money by $3, okay, that $55 call. So let's, there's a stock at 52. The stock at expiration, we going to make any money? Yeah, we're going to make the $175 if the stock, excuse me, in 90 days is still at 52. It may have moved all over the place, but you did nothing with your position and the stock closes at 52. We get to keep the premium we took in, which is the $175, less any commissions that we may have had to pay out. To the downside, you can see at $50, right-hand column, we're losing $25. Well, we're long the stock at 52. Why are we only losing 25 bucks? Because again, that we took in $175 by selling the call. We've got that downside protection of 175, so our break even is going to be 50.25. So at 50 bucks, we lose $25. Now below 50 and a quarter, we're flat out long stock. And that's what we have to realize with the covered call position. There is substantial risk. Many investors, when they put on a covered call, think, I'm hedged. Absolutely not the case. So just be aware. You can see as the stock, heads south, we lose point for point with the underlying. And that's the case with the covered call. Once you get below that break-even point, to the upside, at 55, we've made $475. And even if the stock goes higher to 60, we've only made $475. So let's see why that is. All right? To the upside, basically, we've taken in $175, okay, by selling the 55 call. So why don't we take that strike, 55, plus the premium we took in, plus the $1.75, takes us basically to $56.75. Well, we're on the stock at 52. So in essence, if that stock takes off, we're out. Our maximum profit is the difference between 52 and 56.75, or 475 bucks. I hope that makes sense. All right. That's why this whole idea of in the money, at the money, or out of the money when it comes to deciding what strike we're going to sell is really important, critically important to our returns. But I think that decision, which, can be challenging depending on, the factors and how you go about creating a covered call. Do you take the overall market in consideration? Is it just your opinion on the underlying stock? Do you have a discipline, where you write these calls every 45 days, same strike, boom, boom, boom. That's actually part of the fun, trying to figure out exactly what your approach is going to be with the covered call. So that's the covered call. Let's move on to the protective put and the collar. Last couple strategies before I turn it back over to Don. All right, so here's our risk profile. The dotted line represents long stock. Let's stay to the left side in the protective put. You can see the protective put, all right, protective put. That's long stock, long put. You can see we're capped out, in terms of our downside risk exposure. That solid black line, does go horizontal at some point. We'll go through an example to define what that point is. But to the upside, that line just keeps going up. And we'll talk about why that is, in terms of your profit potential. Looks like it might be unlimited. The collar, we'll go through that. You can see, very different to the upside. Much like the covered call, the collar caps your profits as well, and we'll talk about why that is. So the protected put, let's go right to an example. We've got 100 shares. It's our favorite stock, XYZ. Price is 42. So we happen to be concerned about the downside. We decide, we're not going to sell our stock. That's always a possible choice. So we decide, we're going to buy some protection. So we decide to buy an XYZ 40 strike put. Now, I'm not sure exactly all the strikes, the 40 put, is that in the money, at the money, or out of the money? Well, the price of the stock is 42, so it's clearly not at the money. That would have to be the 42 strike, 40 put, right? To sell stock at 40. With the stock higher, $42, that means that 40 put is out of the money by $2. So we decide to buy an out of the money put, and that strike is 40. all right, because, we're nervous about the downside. It's a 60-day put. We pay $155 for the put. What's our risk? Well, if we hold that put all the way to expiration, the stock doesn't go below $40, we could risk, our overall risk is actually $355. It's the difference between the current stock price at 42, the strike price of 40, so that's $200 plus the 155. All right, takes us to 355. Total risk or a break-even point of 38.45. Okay, so and then to the upside, you can see the upside. We've got our long stock, and then we do have, even though, and this is one of the interesting things about the protective put for me, is it a bullish or bearish position, which I think may come up in one of the next couple slides, but it's clearly, even though you're buying downside protection, if for some reason the stock turned around and took off, you still profit handsomely because you've only reduced your profit by the premium you've paid for that put, and in this case that's $1.55. So upside profit, break even is going to be the price of the stock plus the premium paid for the put, $155. So $43.55 to the upside is going to be your break even. Anything above that, is pure profit. So that's the protective put. Collar is two strategies in one. All right, we talked about the protective put. Basically, what you're doing, and with the protective put, you realize we're long that underlying, and then we're buying an option, buying downside protection. So clearly, we're paying for insurance. The point of the collar oftentimes is maybe you've got an underlying that you invested in at a lower price. The underlying's run up. You want some downside protection, but you really don't want to pay for insurance. So what can you do? You can turn around and finance that put with the sell of a call. Now, what's the downside to that? If the stock keeps running, you've given up your upside. Although, and the beauty of options, these positions are dynamic. If you're a little more advanced, or you just talk to your TradeStation representative, you can roll those option positions. So it's not like you put on a position and you have to marry it. It's dynamic. You can roll. But back to exactly what the collar is. It's a combination of the long stock, the long put, and on top of that, it's the short call. And again, the motivations I kind of went through. Oftentimes, you're putting on that collar. You've got profit in an underlying. You want to buy downside protection, but you want to finance it with a call. Quick example. We got, it's mid-September, we're long XYZ, it's trading at 63. It's trading at 63, but we're lucky enough to be long from $50. So we've got $13 in this bad boy already. We don't want to just sell out the stock for whatever reason. We want to buy some downside protection. So the stock's 63. We decide, and you can see the call and put strikes, 50 through 75. Just so happens, and this really is pretty true to life. With that stock 63, it's above the midpoint. The call and the downside puts always cost more. So, there's a particular skew in the marketplace that is going to force you, to be kind of a little bit out of whack. You're not going to be, if the stock were 62.50, you would not be able to sell the call and buy the equidistant put, for even money. But with the stock 63 or maybe a little higher, this is really pretty true to life. You get to buy that 60 put, sell the 65 call. Both transactions are $290. So, your net is even money, and you've got downside protection, less commissions. All right? That's basically how it works. Let's see. If we buy the 60 put and sell the 65 call, downside, and we do that for even money, we are stopped out at 60. We have bought, protection at $60. So minus commissions, we know we're locking in the $10 because we own this thing at $50. So that's the point of the collar, and buying the 60 put. We know we financed it by capping our upside at 65. If the stock, closes above 65 at expiration, we know we're going to have to give up that stock unless we've turned around and rolled to a higher strike. That's basically how it works. Stock closes at 55. We know at expiration, we know that we're stopped out at 60. So we've got $5 of intrinsic profit in that $60 put, and that's basically how it works. A couple different scenarios. You can either exercise that 60 put if the stock at expiration closes at 55, wash your hands of the position, take away the $10 profit less commissions and move on. Or you could turn around, if you believe in the underlying, you could sell that put rather than exercise, stay in the position and maybe roll back into a different type of collar when you think the prices are right. To the upside between 60 and 65, you basically, those options are going to just basically expire, so you have to decide what you want to do with the position. Above 65, similar to, an expiration below 60, you have a decision to make. If you don't do something, the stock's going to be called away. You'll have a $15 profit. If you close out the position and roll up, that's another choice you could make as well. So, like any option position, and with the help of TradeStation, there are different choices. There are different things to manage, and the important thing is to know, what your choices are. Obviously your goal is to earn income, but with the support of TradeStation, hopefully you make the right choices in terms of managing the position. Real quick, just different options when it comes to the different choices with the collar. You could originally put that collar on for even money, as I suggested, but then, depending on opinions, willingness to pay a premium for downside protection, desire to do this thing for a credit, you can pick different strike prices. And, same thing, whether it's the call side or the put side, depending obviously on what call and put you buy and sell, you can do it for even money, a net debit, or a credit.